Even as the recent IIP numbers point to a revival in growth, Aditya Puri, MD of HDFC Bank, says the feeling of gloom and doom is overdone and that he is cautiously optimistic of a growth revival. ETNA's Aniruddha Ghosh caught up with Puri for this exclusive interview.
I think it will be better from here. And let me give you the reasons. Do you think we've had a good monsoon? So God is on our side. So long we have survived on that only. So balance models we'll sort out. So if we had 4.4, people were thinking it will be, pessimistically that it will be below 4.4. It could be 4.3, it could be 4.4, it could be 4.5. But you have a positive aspect of the fact that you have a very good monsoon, and so agriculture compared to a 1.9 will probably be somewhere in the 5 range, which will add 40 to 50 basis points to your GDP. I do believe that even in the FMC meet, the markets have overcompensated for the amount of tightening and the consequent withdrawal, and the US Treasuries have already reacted in terms of their interest rate. But there's a flip side. If you say that the QE3 will be reduced, then the flip side is that those economies are doing better. If they're doing better and we have a depreciated exchange rate, then our exports will go up. And as you would have seen, last 2 months the exports have been showing a very good trend. So will the IT services exports go up, which will again help GDP. Add to that the fact that the government has finally started moving on clearing projects that have been stuck. So we're not talking about new investment. The delta of having 4 lakh crore projects cleared, some out of which are halfway through implementation that were stuck on environment, others that were not functioning because of coal supply, etc., will definitely provide the delta. So if your question is, will we probably do marginally better than last year because we've had a bad first quarter, otherwise I would have said we would have done much better. My own feeling, yes. Can we be cautiously optimistic? I think so.
Right, but also we're seeing a lot of negative optimism in terms of, the kind of number that we've seen from the PMEAC also. It's been cut down to about 5.3% for the GDP growth. A number of international brokerages are talking about numbers sub 4% as well. What's your sense on a realistic kind of number we can look forward for in terms of GDP?
See, I'll tell you, when it was cut down, maybe the original estimate was optimistic to begin with. So if you see, a large consensus has been closer to the 4.7 to 5.2 range. I think that holds probably on the higher side now. Previously people were going to the lower side. And these estimates, my friend, everybody seems to think he has the perfect estimate. 2 weeks back, there was no gloom, doom, rupee has gone, we are gone. 2 weeks forward, with some good measures, now rupee, you say, is stable. People are revising their estimates. You have had $1 billion come in September. So other than intellectual thought, nothing moves in a linear basis. Things move up and down and it works.
Right. Also in terms of the rupee, do you really believe that we are still undervalued as far as the rupee is concerned? And going forward, what kind of levels of the rupee should one be looking at?
See, anybody who's going to forecast the rupee is going to get egg on his face. So I'll give you the basis on which I think what it should be. And then if those bases hold true, then the rupee value will hold true. If you look at the rupee, you can take any measure. You can take purchasing power parity, or you can take a risk-weighted index, or you take a simplistic, which is interest differentials. If we take interest differentials over the last 4 years between us and the dollar, the rupee should be in somewhere in the 60+ range. But that's that's based on fundamentals. When you start dealing on sentiment, you always overshoot. I think we had substantially overshot. We have stabilized to some extent, depending upon the measures. As people see that the current account deficit will reduce because of reduction in gold inherently, some import substitution, some increase in exports, it should remain in that 60 to 63 range, and over a period of time, probably move to 60, but I reserve the right to be wrong.
Right. So also in terms of the US Fed statement, you said that it is going to be very key. What is your expectation from the FOMC statement, and what kind of an impact will that have back here at home?
See, the US has said that they've had too much of a stimulus. And because of that, they did avert the crisis. The jury is still out whether the real economy responded or not, or it was only a financial response. Anyway, their GDP growth rate has improved, so some reversal of the stimulus will happen. Our markets have probably already priced in that reversal. Given the fact that the unemployment numbers in the US did not come to the level that would require major change in the quantum of stimulus, we may be pleasantly surprised. In terms of there may be a rollback, but not to the extent that is required, and that's in the market, priced in.
Right, so a couple of weeks back you wrote an article in a newspaper in which you were slightly critical of the monetary tightening measures that were taken by the RBI. And just to quote you, you kind of said that they've done more harm than good in terms of their impact. How soon do you expect these measures to be rolled back, and what, if you could kind of quantify the kind of harm that they've done?
No, I was not critical, but in hindsight, you can always be wiser. So in hindsight, I was wiser and said that if the purpose of that draconian tightening was to protect the rupee, then what it showed was that monetary policy alone in a high current account deficit country cannot result in protecting the currency, and is probably the wrong way. What it also did was substantially push up the interest rate yields and create some issues in terms of the recovery of growth. So all I said in the article was that in hindsight, if we were to look at this dispassionately, it did not meet the objective that it was intended for, and it had collateral damage, which was not good. So any measure that ends up like this is something that needs to be reviewed, that's all.
So there's been a change of guard at the RBI, and though Dr. Rajan kind of says that he doesn't have a magic wand to kind of wish away everything that we're seeing at this point of time, his spell seems to have worked a bit on the markets at this point of time. What are your expectations really going forward from the RBI and from the policy statement on the 20th?
I think Dr. Rajan has clearly specified simplistically almost his entire roadmap for his tenure. He's talked about widening the investment avenues for pension and insurance companies, which could lead to the development of a debt market. He's talked about reviewing the SLR requirement, which would lead to the government being a little more careful in their borrowing requirements, as well as creating a sovereign bond market. He has talked about looking at the priority sector as to how much good that is doing. He's looked about the effectiveness of financial inclusion. He's talking about transparency. And he's also made a statement that probably, at least implied, I have no insight, I'm just judging from what he said, that if he's going to introduce an inflation index CPI bond, that means his inflation targeting is probably going to be a combination of CPI and WPI. And CPI will have to be reduced substantially, because no issuer is going to issue a bond at 14% or 15%. So I think he's laid out everything. In addition, there are always alternatives, and there is no right or wrong in this, and there's nothing to criticize about. I think the measures that he's put in on the forward swap and what comes in will also bring liquidity in the market. I think the issue today is more liquidity than the rate. If he's a very brave man, he could probably tweak the policy towards the easing side of it, but it's a tough one and I don't want to be commenting on it. So he's got too many balls to play, and as it is, his magic wand has worked. So I think let him be.
Fair enough. Now, all of the optimism aside, we've seen cost of funds for banks really go up, and a number of them have actually raised their rates as well. In this backdrop, would it be fair to assume that credit growth for the system would be a little subdued this year?
Credit growth of the system would not necessarily be subdued only because of the interest rate. Credit growth would be subdued because the GDP growth rate is slower. So yes, it would be, there was a blip that may be because of subsidy oil demand, etc., or wherever. So that 17% was a blip, but in the 14%, just listening to everybody, somewhere in the 14-15% range seems to be reasonable.